Well, hello everybody, Michael Silva here. You're watching the Stock Market Brief Show. This right here is the most important asset to be watching if you are involved in the financial markets. We're going to be talking about that. We're going to be getting to some expected moves as well, talking more specifically about how they work, what I look for exactly in today's Stock Market Brief Show. If you're new here, welcome to the channel. Hit that thumbs up and subscribe to the channel if you like this type of technical analysis and intermarket analysis. Now, the market today had some macro data come out. We talked about that on the last video that we posted. That was ISM non-manufacturing. Well, it came in hotter than expected. You can see it jumped to 56.5 in November of 2022, rebounding from more than a 2-year low. So it beat the market forecasts. And, well, the market didn't respond all too well. There was also some news. Nick Timiraos from the Wall Street Journal reported this. You can see Fed to weigh higher interest rates next year while slowing rises this month. However, in that article, it stated that Federal Reserve officials have signaled plans to raise their benchmark interest rate by 50 basis points. Now, we already know that at their next meeting, which is next week. But elevated wage pressures could lead them to continue lifting it. This is important. Lifting it to higher levels than investors currently expect. So is it going to actually make it to 5%? Or are we going to hold it there for longer? We shall see. But let me tell you, if that's the case, we can see more days like this where just the markets got completely obliterated to the downside. The only thing green on this screen was the VIX. Now, we talked about this little broadening wedge pattern in yesterday's video. We said the target would be right around here approximately by the lower weekly expected move. What do you know? We tagged it today, which is the first trading day of the week. Okay, and remember this. This is why we talk about the weekly expected moves. This is 68% of the time within the expected moves. This is where price will lie, and I'll get more into kind of that momentarily. So if we zoom out, though, you can see where price is currently, how we pulled back into just this prior chop box, right? So we broke back into the chop box, or right by that weekly expected move. The lower, we're below the 5-day moving average, which is still inclining. And then to note that this could very well be wedging, right? And then the RSI is picking up, and then we have this PMO, price momentum oscillator over here, is curling up here slowly too as well. So this big scary day could potentially be something like this where we gap up and we start ripping back. Okay, that's always a possibility, and we got to be open to that. Now, before we get into the weekly expected moves and kind of how to determine it, I also want to just revisit this chart, and this is the wedge that everyone's keeping a close eye on, but we'll talk about this more specifically when we bring up the chart of the dollar, which is the most important asset to be watching. So what can potentially get this thing to break down further, maybe even a 2 sigma move out of that weekly expected move? Well, we have more data coming out. Tomorrow, we have the balance of trade. I don't know if this is going to necessarily be all that major, have a big impact on the market. Comes out an hour before the market. As you can see, it is highlighted in red. So according to Trading Economics, this is considered a major report. So we'll see how the market responds to that. Let's hop into the weekly expected moves. We shared these ones yesterday, and as you know, these are just it's the expected move that the options market price in via implied volatility. They look at volume, open interest, and they come to a calculation and spits out a calculation saying, hey, the risk right here is plus or minus 66.47 for the week when we look at the week. So at the close of business Friday, a little bit after the close, potentially even Saturday, I'll look in to see what the expected move is for the S&P 500 and pretty much 40 other products that I track. Okay, and then I'll get these numbers that are plus or minus in a determined amount of risk. Now, many people believe, okay, well, they change constantly. Yes, they do. They are dynamic. However, you got to understand that the S&P 500 is the big product here, okay? A lot of hedging takes place. A lot of professionals use SPX. This one is incredibly important to keep a close eye on. And the reason why I like these weekly expected moves is this right here, okay? The market was saying, and this is billions of dollars to come up with this, okay? So you say plus or minus 66, and this is taking all the open interest, all the volume going into the close basically of Friday, okay? The close of business a little bit after. And it's saying to me that, hey, this is what everyone is positioning for going into the next weekly expiration. Okay, so that's what's important right there. So at the close of business, so open Monday, the market and the market participants, everyone involved trading SPX options, are expecting to see a potential move of 66.47. And we reached that today pretty much on point. Now, that doesn't mean that we can't break outside of it. That's where people kind of get a little confused. Like they say, how accurate is it? Okay. It has nothing to do with active support or resistance lines. That's not what these are. So if we take a look at a bell curve, okay, so think of it as a bell curve. you got to understand, if we break the weekly expected move, it is just one standard deviation. So if you look at one standard deviation of a bell curve, you would be looking at roughly 68.2. So 68.2% of the time, it finishes within that weekly expected move. That does not mean that it can't come outside of it. Okay, we've seen 2 sigma moves, right? Boom, right here. We've seen these type of 2 sigma moves all throughout 2022. But you notice 95% of the time, there's a probability of it staying within that range, okay? So these are important levels to know, because if the S&P 500 comes way out to here on day 1, people are going to get frightened. But as you'd see, well, 95% of the time, it closes within this. And when you're a market participant, you're dealing with probabilities, okay? You're always looking at terms of probabilities. So if we know that 68% of the time it closes, and by the way, the S&P 500 actually, if you back test this, it actually is higher than 68% of the time. But we'll go with 68% of the time. So if the S&P 500, we know that it closes almost 70% of the time within this weekly expected move, what can you do with that information? Well, if it comes outside of it early on, you might be able to say, okay, well, I might be able to take an intraday trade back into the weekly expected move, because 68% of the time we land back within this zone. So that is why the probabilities favor, right? So if you're aware of, okay, almost 70% of the time it's going to close within this, and we're way outside right over here, okay, and things are getting extended, and you're looking at your other indicators, RSI, maybe a positive divergence is forming, you can simply say, okay, well, I like the chances of going long right here, maybe intraday, maybe not. Or if you're short and it's coming down to here, you would be looking at this and be like, well, okay, maybe I should cover some of my shorts, because there's a high probability that we come right back into this weekly expected move. So that's how I determine it. That's how I look at it. So yes, these numbers, they stay put, because this is what the market, it's what it said is the risk for the week ahead. From the close of business Friday till the next week, this is what the market said and prepared for, and that is that 68% of the time right here. So if it wants to break a 2 sigma, okay, fine, then we'll let it do. But that's where probabilities come in. You can do advanced option strategies outside of these. You can take trades, you can do whatever you want, or maybe reposition portfolios. It all comes down to the individual trader. So I hope that made some clarification of what it is that I look for. But I can tell you this, earlier in the day to the Patreon, right as soon as pretty much this clicked to the lower weekly expected move, this is where I said, okay, well, I would imagine that people are going to start covering around this area if they're short. So I had a bunch of different equities that were short, so I started covering some of them in this area. Do you think I really care about the move that went down here? Not really, because then at that point, you can really look at this. Now, I wasn't trading intraday today, but if it got more extended to the downside, I'd say, okay, well, now I can cover some more, right? It's not like an all or nothing sort of thing. I can cover some more, or potentially look to add long on equities that are actually doing good in the overall environment. So for example, like we're looking at the SPY right now, well, what's something that's been doing good all year? Well, consumer staples have been doing pretty good. Utilities have been holding up, and those are actually pretty good in this current environment. So as we get out here, you can look towards bigger names in those areas. That's just an idea. All right. I like I said, I didn't trade today. I covered some of my shorts, but that's it. I didn't put anything on. So now we are currently outside of that weekly expected move. As far as these anchored VWAPs go, we have the FOMC anchored VWAP, which is the white one. We have the month-to-date anchored VWAP, which is the orange one or yellow one. And then we have the week-to-date, which is the today it's the start of the week, and we're trading all under those anchored VWAPs. So if price wants to come back up in a rapid move, start looking towards these anchored VWAPs up here, because they may hold as a potential area of resistance that we'd want to see. Another thing that you want to pay attention to is to see how price acts within this area. Sometimes you'll see a price just doodle around in a zone around here and just kind of relax until the next week is on. So we're dealing with the safety zone. If it starts breaking outside of this area, we can see some big moves take place, because of obviously the market participants, the big dogs, right, of the market will have to kick in. The dynamic hedging takes place, so they'll have to, readjust their positioning. So if we do see shorts and we start seeing a little bit of a rally, start looking for a possibility of some sort of a flag pattern, maybe where we look something like this. Maybe the anchored VWAPs come back down. Maybe we get outside of the purple line, which is the 5-day moving average, we go up and potentially look to something like that where it can break down. So that is a potential path that we may see take place, okay? Remember, this week right over here, this big one, this actually was the lower weekly expected move from the week prior, and this was the upper portion of the weekly expected move. And in 1 week, we tagged the bottom, we doodled around, a report came out, or Jerome Powell came out, sorry, and then boom, we came up right to the top. So what can potentially, cause this to go back up to the top? Well, we have more macro data coming out. One of them is this balance of trade report, and we got some more stuff coming out. So always be aware of your levels and just be careful. Now, we talked about this chart. This is looking at back month versus front month volatility. This typically marks sometimes, if you get up into this area, marks sometimes topping points where we talked about in the prior video. We talked about this chart too. The VIX closed at 20.75, which roughly correlates to about a 1.3% move in the S&P 500. So the volatility is elevated. So we can expect potentially around a 0.3% move in the S&P 500 where the current VIX levels lie. Now, we talked about this prior pattern. As you can see, we're coming into, in the S&P 500, a prior area of resistance, and it's getting hit right now. Doesn't mean that it's going to break down fully. We don't know yet. It could just be temporary, and we can go like that, and have that Santa Claus rally potentially. We don't know, but VIX is also coming into that prior area of support where we've seen it prior come into as well. This is known as the Cookie Monster pattern, so be very aware. This is what I am telling my future kids was the monster under my bed. So back to the asset that everyone should be keeping a close eye on, that is the dollar. The dollar is so important to watch here because just on not even a huge update, but a pretty decent update in the dollar, it has a huge impact on financial markets. And you can see that. You can see prices tightening up here, and it's coming to this area of support, and it has the potential to break out. And this, right, there with a strong negative correlation, that could potentially break the S&P 500 down. Now, understand, we're going to go into a couple other assets, but when the dollar was moving up, if we take a look at something like gold, look at the effect that it had on gold today. Down 1.56. Now, gold was getting frothy, had that negative divergence. We talked about that. So we'll continue to watch this for a pullback into potential key levels, maybe even if the dollar gets heated, because this one has been breaking out. It's looking pretty strong. So this could be an asset to watch on these pullbacks. Take a look at oil. It was down 3.81% on the day on today's dollar move. You can take a look at copper. It was down 1.44%. This is kind of an interesting chart. I've been following these divergences. So if the S&P 500 puts in a higher high while copper puts in a lower high, it's resolved to the downside, as you can see here, here, and here. So bear market rally 1 got destroyed. Bear market rally 2 got destroyed. This is bear market rally 3, at least that is until proven, guilty. And will this be, a turning point potentially to see it knocked down? I don't know. But it also works on the flip side too, where you look at the blue lines and you have higher lows in copper, lower lows, and we talked about that while it was happening, lower lows in the price of the S&P 500, and that led to that bear market rally, as you can see right there. Now, I want to go into the bonds. So TNX was up today 2.65%. So the 10-year yield is at 3.5%, and it's also within this wedging pattern right here too as well. You can see bonds got taken back a little bit, but this is to be determined, right? We talked about our zones and where they were priced, and things were getting hot. Things were getting extended within their ranges, and you can see that they are starting to back off slightly here. The yield curve is now, the 10 and 2 is at minus 81 basis points. The 10-year and 3-month is at minus 76. So if these things are getting hammered, this one just put a new low, I believe, on the year right there. Just incredible moves. And if you take a look at the summation index, it's still positive as it stands right now. We have that negative divergence on the Nasdaq McClellan oscillator. So is the trend going to change? Is this going to tick back over and then potentially identify a potential change in trend like it did here on that bear market rally where it ended? And on this one where it ended, is this going to tell us when the third one ends? It's almost too easy, it sounds like, but we got to be aware of it and just be cautious that if it does start turning, the Nasdaq composite could mark a potential new leg to the downside. Now, if we take a look at the BPCO and PQ chart, bullish percent index, it came off the overextended area, but you can see the negative divergence is playing out to the downside as it stands right now. Price action of it hasn't really came off too much, but this could be the early start of it, so we'll monitor that. BPSPX chart's also moving outside of that overbought territory, 68.22. That negative divergence is somewhat playing out, but we'll see here if this wants to come back down through the 50 line, if this wants to come cross down back through 70 or even 60 back through here, that could indicate that we might see some weakness. Continued weakness there in the S&P 500, some follow through from today's day. And it's hard to say because like I said, we're already at that lower weekly expected move. So something's going to have to kind of break to see a 2 sigma, like something's going to happen. There's going to be some sort of catalyst for that to see it come off like that. If you take a look at the summation index for the New York Stock Exchange, this one's also pointing straight up still, so no curve there. Still watching this negative divergence. I've been talking about that 0 line on the last video. We haven't crossed through it. It's at 4.99. However, if it does cross down through 0, that could indicate more weakness right there too as well. Quick look at the zones from yesterday. These are yesterday's zones. See how it was all red on the screen basically, and we talked about how, the VIX is getting to the lower range of the zone. The 10-year yield is coming to the lower range of the zone. The dollar came to the lower range of the zone. And guess what? All those bounced. Okay, that's why I like using this tool. It gives a good overall view in the market. If you want to join the Patreon, I actually share the zones, but on many assets. I use global ETFs. I look at fixed income. I look at volatility. This is just a snapshot of some of the important assets that I like to share every once in a while. It's only $9 a month. I don't even list the zones on the benefits over here because I just haven't done that yet. The weekly expected moves is something that I do share. I give a watch list. I update it when there's stuff. I'm way more active when the market's actually a bull market because my watch list is more for the bullish perspective, and it just hasn't been that bullish, obviously, in 2022. But I did recently update it because some price action was getting tight. And then I share swing trade setup ideas. Like I'll just post some on my charts and stuff in there. And then you have access, obviously, to the community. I do that all for $9 a month. That's what helps support this channel. It helps what support me leaving my 13-year career at a Fortune 20 company too as well. Now, what do we see at the zones taking place right now? Well, IWM got hit hard. It's coming to the lower range. The dollar is an important one to watch because the dollar still has 2.3% upside to 1% downside. So if the dollar starts heading up, I would imagine we'd see more green on the screen overall because it can definitely hurt these assets. But you can see a lot of the red has been worked off, and you can see things like energy right down here, way down towards the lower range. It closed at 87.63 and its lower range is at 87.39. Okay, so it's outside of that, so it got hit hard. So I would expect potentially to see a bounce. So you don't want to, and we talked about shorting XLE yesterday, but you don't want to short it in the hole. Can it go down further? Absolutely can go down further, and it could cast some follow through. But this isn't the type of stuff if you're managing risk of exactly where you want to trade. You know, it's a funny story. Like I made a video, and it was called Will Tesla Save Thanksgiving? Do you remember that video? So Tesla was just boom, it was getting hit hard and it came down to this low area, it closed at the low of the day, and then I'm coming out with a video that says, will Tesla save Thanksgiving? And the thing was, yeah, like it looked like we had the potential while fear was out there, we can see a bounce. And then I said, hey, if it bounces up to around 195, that could be a potential good short area. Well, we saw a massive run and everyone talked about it. And then my buddy texts me and says, I just put $10,000 into Tesla. And I was like, you did not watch my video. And then Tesla got hit, right? And that's, you can see that within these S&P 100 zones that I share. It got red hot, and this is what typically people do is when all of a sudden things start moving up in a direction or getting some momentum, people FOMO into these moves. And it goes both ways. If you get hit to the downside, bam, people will close out their positions, right? When they should have managed risk up here. And then when markets start rallying, they're like, okay, I'll go long right here. And then boom, to the downside. Now, I hope that doesn't happen to you, but if it has been happening to you, understand, don't make it a make or break, right? This is all about moving inventory around, okay? It's not just one trade that you want to take. You want to have all types of inventory, and when they go up in value, you can sell some of it, right? And then if it goes back down and you really like the position, add some back. And it goes for shorting, it goes for longing. That's just what you have to do. You got to not get married to any one stock, and you just got to be very tactical, including in this current environment where the VIX is above 20. It is, as you can see, the market, the S&P 500 has been just taking us for a ride, right? Big old choppy moves, shaking people out until we get some sort of, clear decision of where we're going. It's going to continue to be like that. And in order to have a really strong bull market, you don't want VIX, trending above 20 like this, right? You don't want the VIX relatively high. You want the VIX down in this zone, down in here, and you want it to stay down there where you can see the market just kind of trek itself up nice and slowly, and everything's good and everyone's a winner. That's all I got for you on today's market brief, everybody. I went on some tangents there, but I hope it helped out. See you later.